Sounds logical enough. That's because stocks turn on a dime. Most traders cannot. As traders, we all want to capture short-term explosive moves. Yesterday, I showed you how we did so in an upside earnings reversal in Square. I'm Jeff Cooper, creator of the Hit and Run method, and I write the daily Hit and Run market report. In this video, I'm going to show you Friday's downside reversal, earnings reversal in Workday, WDAY, and the game plan for how to capture it. So let's take a look first at today's 10-minute. There's accelerated momentum associated with earnings, and in tandem with my bowling for strike strategy, which we're going to walk through, this pin action can present outside opportunistic plays. Earnings reversals, both up and down, can accelerate on weekly and monthly Friday's option expirations. Friday was a weekly option expiration, and Workday, WDAY, reported Thursday night. In yesterday's video, we took a look at an upside earnings reversal in Square on Thursday. We ended the video by asking, where's Square going tomorrow? Friday? Who knows? It's hit and run. Next? Well, next indeed. Square was down 3 points, over 3 points on Friday after what looked like a big reversal on Thursday. So you never know. Well, WDAY reported Thursday after the bell, and it gapped up on Friday to new all-time highs to the 200 strike right here. It literally kissed the 200 strike. Happenstance? I don't think so. That record new high was short-lived, literally, as in seconds. Look how it knifed down in the first 10-minute bar. WDAY oopsed. I call it an oops setup when it knifed through the prior highs at 199 and kept going. Let's take a look at the dailies and you can get a better picture. So it gaps up here to a new all-time high, and then it oops right through the prior all-time swing highs here. So it caught sellers. Go back to the 10-minute. Trade through Thursday's low of 195.70 right here opened up the doorway to a push down to the 195 strike. So it kissed the 200 strike, and when it knifed through the prior swing highs and then knifed through yesterday's lows at 190, I think that was around 195.70, that perpetuated a push all the way down to the 195 strike. When it broke the 195 strike, it was magnetized literally right to the 190 strike. The low here was 190.10. Happenstance? I don't think so. This is a derivative game where the tail wags the dog. The option tail wags the stock dog. The tip-off to banking the push to the 190 strike once it broke Thursday's 195.70 low was twofold. Now, not only did Workday's reversal telegraph that the 190 strike was sitting like a turkey on a fence, but so was the 20-day moving average just above 190. Let's take a look. So here, this red line is the 20-day moving average. Once it broke the 195 strike, it looked like the 190 strike in tandem with the 20-day moving average at 190 was in the crosshairs. Putting the pieces together led to a superior intraday hit and run setup. Back to the 10-minute, and we'll see how after testing the 190 strike rather, WDA bounced to, you guessed it, the 195 strike. See here? Happenstance? I don't think so. From there, Workday rolled over and undercut the 190 strike, trading down to 187.50. Note the three drives to a low. Often markets play out in threes. When you see three drives to a low or a high on whatever time frame you're trading in, it usually means it's a short-term pivot. From there, WDAY traded sideways, as you can see. Basically, the rest of the session, the day was done for that. The opportunities were done. So after the opening volatility explosion, Workday contracted, going sideways, reflecting the underlying nature of price action as I see it. Stocks breathe. They inhale and they exhale. They expand and they contract. Not only do they expand directionally, but they expand as to the size of the bars on whatever time frame you're looking at that's under that you're trading on. So you get this twofold expansion and contraction, both directionally and as to the size of the bars. So that's important to remember. What will Workday do on Monday? Well, let's take a look. Here we go. It did leave a large range key reversal day. A key reversal day is a new 52-week high, which we got, with a close below the prior day's low. And it's a large range key reversal day at that. This suggests lower prices, but who knows when. It could consolidate first, and I'll be stalking it, looking for a new signal for our members. It's hit and run. Next. That's it for now. If you liked this video and you find my approach to the markets interesting and you want to learn more, please click on the link and get a free copy of my classic bestseller, Hit and Run Trading. And if you enjoyed this video, be sure to like. Have a great weekend. See you next time.